very difficult to implement a force majeure clause on the failure to delivery of a short on the Comex for gold or silver or other commodities like oil or whatever the case may be, because they're just going to pay you out in cash based on that. So again, this was not set up to be primarily a physical clearing market. There is physical clearing procedures, but it's geared more towards a derivative market. And in any case in which somebody can't deliver, there is a cash transaction and there are insurance funds and potential assessments for that. If you wanted to receive silver at 108 and there wasn't enough silver to be delivered and the price went to 110 by the time you got all this settled, then they'll pay the difference, but they're not guaranteeing delivery of the physical assets.
The belief that a Comex force majeure event is imminent due to physical gold or silver shortages fundamentally misunderstands the exchange's core function, because the Comex operates primarily as a derivatives market rather than a physical clearinghouse. Implementing a traditional force majeure clause for delivery failures is highly improbable. When a short seller cannot deliver the required physical metal, the exchange resolves the deficit through cash settlement. RobertKientz, founder of Gold Silver Pros and a veteran precious metals analyst, clarifies the mechanics behind these procedural safeguards. In scenarios where physical metal is unavailable, insurance funds and cash assessments ensure the paper market continues to function. If a buyer demands physical silver at a specific strike price, but the metal cannot be sourced, the exchange will pay out the cash difference based on current market values. By prioritizing fiat payouts over physical fulfillment, the system avoids a technical default, but it leaves investors seeking tangible assets completely exposed to paper substitutions. Now, we present the clips from RobertKientz's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
CME Clearing has defined default management plans for managing a clearing member default event. These plans are designed to minimize losses and ensure the continuity of CME Clearing's clearing services to non-defaulting clearing members and their customers, while supporting stability of the broader financial system. Blah, 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 blah. So here we go. The CME Group Exchange Rule provides CME Clearing the ability to declare a clearing member in default upon its failure to promptly discharge any obligations. In the event of a clearing member default, CME Clearing may liquidate any performance bond, guarantee fund contributions, and any other assets posted by the defaulted clearing member to cover its outstanding obligations. That could be settlement variation payments, costs, things like that. This includes the costs associated with liquidating, porting, and managing the positions of a defaulting clearing member. So if a clearing member can't deliver the physical metal or can't in any other way support their position, a lot of these positions will get moved to other members which can. So they simply basically cut and paste the trade to another member that can do it. And that's a way that you can prevent agreements from going completely belly up. And what they'll do is they'll liquidate the performance bond requirement and other things that defaulting member had put up to help pay for it. And according as I read 3 or 4 different pieces on the CME Group's website, they've never had to use any of their own insurance fund to deal with a defaulting clearing member. The clearing members always had enough money or interest in the market to be able to pay for any defaults that they've had. So the CME Group has never had a large-scale default of a clearing member, which could at any point in time put the market at risk, if that makes sense. In the event of a clearing member default, CME may liquidate any performance bond. All those things includes the cost of all that stuff. And then they're going to port. So in the event a clearing member default, CME Clearing seeks to port the defaulted clearing member's customers. So they're just going to move those customers from that defaulting clearing member to another clearing member, which may be able to support those obligations. So if the defaulted clearing member supports customer clearing and the customers are not in default themselves, CME Clearing would endeavor to port the customer accounts, including positions and performance bond value, to a single or multiple non-defaulting clearing members. If a bankruptcy trustee has been appointed to manage the estate of the defaulter, CME Clearing would work with the trustee. CME Clearing conducts ongoing default management planning and regular drills, which includes exercises to identify clearing members with similar or complementary customer profiles that may be positioned to accept non-defaulting customers. So they're proactive in identifying who can take the trade if somebody defaults and can't get their position or support their position that they've taken, whether it's long or short. Importing success has increased the result of CME Clearing's gross margining practices for all unaffiliated customer accounts. In particular, with customer gross margining, CME Clearing sets a minimum performance bond level as a sum of the requirement calculated. And when you see the market get frothy, they increase the margin level. So the CME Group, I think 3 or 4 times in the span of the last couple of months on the exchange has increased for gold, but silver specifically. Some for gold, but even more for silver, the percentage required to put up against the contract And that's presumably, and a lot of times that slows down trade and can stop a bull market, or it can stop even a short slide, because you're increasing the cost of playing the market, which is going to reduce people opening positions. And we certainly saw that on the Commitment of Traders report, where you had all these positions exiting the market. You had 13,000 in silver, and if you go down here to gold, you had 78,000. Well, that's because it costs more to put a contract on the market. But what it also does is it puts more money in case one of these members defaults. And so if the CME group sees the trade getting distressed in one direction or another, they increase those margin requirements, which slows the run, but it also puts more money in the system in case somebody defaults. There's a whole auction and liquidation process you can read about, and there's $100 million in a special insurance fund. Let me see if I can get the graphic. Here's the graphic. So there's a safeguards waterfall. So on IRS products, it's 150 million. On other base metal products, it's 100 million. You can see over here of contributed capital between the member groups. That's an insurance fund. So even if a clearing member performance bond is not enough to settle a defaulted trade, the CME has an insurance fund. They say that they've never had to use it at this point to liquidate or to handle a defaulted clearing member on any of the trades, whether metals or other, but it's certainly there. They have a non-defaulting clearing member guarantee fund. They have a guarantee fund sized to cover losses, performance bond guarantee fund. So they have 275% of each non-defaulting clearing member's guarantee fund is general assessment powers, which is the last stage, which is if the clearing insurance fund, the guarantee fund are enough, they can go assess all of the current trading members for an extra 275% of the defaulting members' liability. So the defaulting member was defaulting on $10 million worth of silver contracts. The 100 million would capture it from the insurance fund. And it would be paid from their performance bond first and then the insurance fund. But let's say it went to 200 million, like it was a really big default. Well, the CME group can assess the rest of the trading members for the benefit of keeping that market liquid. So there is a whole process here for dealing with one defaulted member taking down a market, or just dealing with the fact that you could have a member defaulting, but it's not the end for the person on the other side of that trade. The person on the other side of that trade may get cleared by another entity because the CME group's going to catch that defaulting member. They're going to take all their money that they put up for performance and try to pay it off. And they're going to move those unclosed positions to other market participants. And in this insurance scheme, the other market participants can get assessed additional money that can help cover a default. So if the entire market defaulted, this would not work. It's an insurance scheme, but there is a robust insurance there in CME Group to prevent a default from taking down one member or a group of members. And there are some fees and things built into that, just so that you know. And then we want to talk about liquidation and the process of liquidating. So that's in section 826 of the rule book, which I'm going to basically, we're going to go down to the liquidation section. We're going to read through. So default by base clearing member, this is really small, but I'm going to do my best to kind of read. I'm not going to read the whole thing, but I'm going to give you a flavor so you understand that there's an entire huge section of the rule book dedicated to default and clearing. So it says if a base clearing member of CME, CBOT, NYMEX, or COMEX, or an OTC clearing member fails promptly to discharge any obligation to the clearinghouse, or becomes subject to any bankruptcy, reorganization, arraignment, insolvency, moratorium, or liquidation proceedings, or other similar proceedings under U.S. federal or state bankruptcy laws, any comparable non-U.S. laws, or other applicable law, the clearinghouse may declare such base clearing member to be in default. And the clearinghouse will post a rule, and they will mitigate any loss caused by such default. They may engage in commercially reasonably transaction. They may buy metal in the case of gold or silver if they can buy it to help the defaulting member with those insurance funds. So even if you needed physical or cash, they have the ability to do that. They can eliminate the risk created by the default, including entering into hedges, liquidating positions in the market, auctioning or selling a portion of the portfolio of the defaulting firm, offsetting book entry positions. In other words, if you're heavy to one side, long or short, they could do a book entry position to kind of help clear you out and use money to clear those positions just to relieve the derivative pressure part of it. They maintain plans for managing the default of a base clearing member. And as you go down, and it talks about how they handle the collateral that the default clearing member is putting up per contract. and then how they apply that. And they've got rules 804, 8F05, all of that to deal with that. So there is a huge section, and there's allocation of assets, management of obligations, payment obligations, losses are finalized, clearinghouse obligations, so on and so forth. I mean, it is extremely detailed on how they do this.
The CME Group maintains a robust default management plan to maintain stability in the precious metals market in the event of a clearing member failure. Rather than allowing a market collapse, the exchange utilizes a process called porting to seamlessly transfer a defaulting member's open positions to stable, non-defaulting members. To cool frothy markets and build a financial safety net, the CME actively increases margin requirements to slow down rapid market runs. If a massive default occurs, the exchange relies on a multi-layered safeguards waterfall outlined in Rule 826. This defense mechanism starts by liquidating the defaulting member's performance bonds. If those funds fall short, the CME taps into a dedicated $100 million base metals insurance fund. As a last resort, the exchange holds general assessment powers, allowing it to charge remaining trading members up to 275% of their guarantee fund to cover the deficit. This ensures the derivative market remains completely liquid. Let's get back to the interview.
I wanted to explain a little bit about deliveries on the market so people understand and talk about the delivery process. So there are deliveries and then there are loadouts. Loadouts when you take the metal off the exchange. So the 4 million ounces of silver that I highlighted at the beginning of the program, that was loaded out and actually taking off of the exchange. Delivery is basically saying you have metal over here in this Comex approved depository. I want it, put my name on it, but I'm going to leave it there just because it's already there and it's safe and I can pay those storage fees and I don't have to actually move the metal. And so that takes it out of registered to eligible, but it's still in a Comex approved depository. That's delivery. So delivery does not imply a physical move of the metal. That's the loadout, which is the next step. So sometimes when you take delivery, it's just people passing metal back and forth. Maybe somebody needs that metal to guarantee some position elsewhere in the market, so they're going to leave it on the Comex. Or maybe they eventually want to take it off the Comex and use it physically, but why remove it and move it there to your place and then move it somewhere else? I mean, it's just going to be expensive to move. So a lot of times they'll leave it there. But here's the delivery process. So it says the CME Group exchange rules provide CME clearing the authority to declare a clearing member in default upon its failure to promptly discharge its obligation to a clearing member for bankruptcy and default. In the event of default, CME may liquidate performance bond, all that kind of stuff, and the financial safeguards waterfall, which you've seen, which were the things that I showed you, the insurance and the assessment ability and things like that. Delivery process for a futures contract with physical delivery. Pursuant to Rule 716, clearing members are responsible for ensuring account owners and physically deliverable contracts have the ability to make or take delivery. During a deliverable futures contract delivery period, accounts holding open positions can incur delivery obligations. A short position holder must be prepared to deliver the underlying commodity, while the long position holder must be prepared to take delivery of the underlying commodity and pay the full delivery value. And they go on to outline ways or scenarios in which the longs can actually take delivery. So there is a settlement process. There's a day 1, a day 2, and a day 3. There's a delivery performance risk, which is what the CME Group works with. There's a delivery margin, and that's a margin you put up to guarantee that position. And then there's a whole failure process and rules for that. And if you go deeper into the rule book, as I looked at section 713, delivery procedures, it goes on to talk about the relevant documents, payment, and failure. They have a section on failure to deliver, which I want to read for you. So in the event a clearing member fails to fulfill its specific delivery obligations pursuant to exchange rules, the sole obligation of the clearinghouse is to pay reasonable damages proximately caused by such delivery obligation failure in an amount which will not exceed the difference between the delivery price of the specific commodity and the reasonable market price of the commodity at the time delivery is required according to the rules of the exchange. So in other words, if somebody fails to deliver, the CME Group delivery exchange clearinghouse, which has collected all this money, will pay the difference to the person that couldn't get delivery so that they can go buy metal off the market if they want to, but they only pay the difference. And then what's used to settle the actual cash portion of the contract is the performance bond and things that the actual participant put up. So the insurance fund handles the difference. But notice here, they're not guaranteeing delivery. They're talking about making a cash settlement on failure to delivery. The clearinghouse shall not be obligated to make or accept delivery of an actual commodity. It says right there, the clearinghouse does not have to guarantee delivery of gold or silver if one of the shorts defaults. They only guarantee the difference in price should the long want to take that money and go buy it on the open market somewhere else. So there's no requirement here that the clearinghouse makes that the short has to deliver. If they can't deliver, then they get docked for whatever they put up for the contract, and the clearinghouse will make up the difference in price on the settlement day, which is usually a few days, 3 to 4 days, so that that person can go buy it somewhere else. But it does not have to force delivery on either the long or the short side, for the shorts to put it up for delivery or for the long to take delivery. And so that right there is where it gets very difficult to implement a force majeure clause on the failure to delivery of a short on the Comex for gold or silver or other commodities like oil or whatever the case may be, because they're just going to pay you out in cash based on that. So again, this was not set up to be primarily a physical clearing market. There is physical clearing procedures, but it's geared more towards a derivative market. And in any case in which somebody can't deliver, there is a cash transaction, and there are insurance funds and potential assessments for that. So that's why you don't get the hard default on Comex when you have so many contracts standing for delivery and then it doesn't default. And then social media has blown up this whole time saying, well, it's going to default, it's going to default. And for 5 years, there have been talks about the Comex defaulting on silver because of thin inventories, lack of mining output, and it never happens. And you're seeing right here in the rules why. So number 2, the clearinghouse is not obligated to pay any damages related to the accuracy, genuineness, completeness, or acceptableness of certificates, instruments, warehouse receipts, shipping certificates, or similar documents. So if somebody had claimed that silver were in the warehouse and it wasn't there for delivery, the insurance fund doesn't cover that. It doesn't cover that at all. It just covers a couple of days of potential price movement for the person should they want to take that money and go buy physical silver elsewhere. It doesn't pay any damages. The clearinghouse does not pay any damages relating to the failure or insolvency of banks, depositories, warehouses, shipping stations, or similar organizations or entities that may be involved in a delivery. Notwithstanding any provision of the rules, the clearinghouse has no obligation or liability to any clearing member or any other person relating to a failure to fulfill a delivery obligation unless it is notified by the clearing member that did perform or was in position to perform its obligations that a failure occurred as soon as possible, but an event no later than 1 hour after the delivery deadline for the respective product, which may extend to the global headed clearing. So if there is a dispute and something didn't get delivered, and within 1 hour after that delivery date it did not get reported, then the clearinghouse is completely off the hook. So you basically have 1 hour if you're standing for delivery and there's a failure to deliver to report it to get any sort of compensation whatsoever. That is an extremely tight window if you're dealing on the market with a physical delivery. It says if a clearing member does not fulfill its delivery obligations to another clearing member, it's responsible to the clearinghouse for any damages. They're just going to pay cash, and they're going to pay it out of their margin or through a special assessment. They're not necessarily going to kick them off the market. That's why you see these big banks dealing for a long time. And if they fail to deliver on a contract, they don't get kicked off the market necessarily, unless it were really egregious. It says a failure by a clearing member carrying a short futures position to tender a delivery notice on or before the time specified on the last day which notice is permitted shall be deemed a violation of the rule. Unexcused failure to make delivery should be deemed an act detrimental to interest or welfare of the exchange. In addition to any penalties, they can assess the damages incurred by the buyer, but it doesn't say they're going to kick them off. So if you read through all the stuff, and I read through it all, about force majeure and deliveries and default liquidation, there are several layers of protection preventing any entity that does not have the required commodity to actually physically be delivered, whether it's gold, silver, oil, or whatever, and that there's insurance funds to do a cash settlement on the difference over that 3-day period between the notice of delivery and the failed delivery date. There can be assessments against people that fail to deliver, but it doesn't explicitly include every time kicking off the market or suspending their license. That probably would go through a separate process and elsewhere in the rulebook should the CEO, COO, or somebody in the clearinghouse and in the CME group want to do that. And there also is enough silver on the market to handle most delivery requests in a given month on Comex, because remember, if you go back to my masterclass series and I looked at the numbers, usually less than 0.5% of contracts traded daily have a physical delivery component. And even though they're physically delivered, it's just exchange of a warehouse receipt, not a physical loadout.
Understanding the actual mechanics of the Comex reveals why a hard default on physical silver is functionally impossible. Market participants frequently confuse a delivery with a loadout. A delivery transfers ownership of the metal on a warehouse receipt, while the metal remains untouched in the exchange's approved depository. A true loadout, the actual physical removal of the metal, is exceedingly rare, representing less than 0.5% of daily traded contracts. When a short seller fails to deliver, exchange rules explicitly state that the clearinghouse is not obligated to provide the physical commodity. Instead, they enforce a cash settlement covering only the price difference. Buyers also face an incredibly strict 1-hour window to report a delivery failure to receive compensation. Ultimately, the system is designed to protect its own liquidity through fiat payouts, rather than guaranteeing physical assets, completely nullifying decades of default rumors. Share your thoughts on this analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.